Hi, and welcome back to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager with Canaccord Genuity Wealth Management. And in these videos, we like to take deep dives into everything financial. So we appreciate you watching. Keep in mind, these are for information purposes only. Do not use these as advice. Always talk to a professional before acting on anything we talk about in here. Or do your own due diligence to make sure it's the appropriate strategy for your situation. So with that, let's dive in. This week, we're going to talk about portfolio management and what it means. People always talk about portfolios. They always talk about how they're investing. But I think it's important to really understand the difference between trade-in or stock picking and portfolio, because a lot of times they're considered one and the same when really they're very different. As a portfolio manager, one of the number one questions I get from people, friends, what's your top stock pick? And I always have the same answer for them. I don't have a stock pick because the choosing one position or one stock or one name for your portfolio infinitely increases the risk of that investment, because you don't have that power of diversification working on your side. Even if you have multiple stocks, diversification is more than just having numbers on your side. It's having sector diversification, geographic diversification, risk diversification, depending on what type of positions you own. And that's where portfolio management comes in, or that's where portfolios come in. It's really important that your portfolio is structured properly to meet your goals and meet your risk strategies. Because every portfolio is different, everyone's risk strategies are different, and it's important that they match up. Otherwise, you could have a good portfolio, but it's not serving your needs. So when we build a portfolio, a lot goes into it, not just the individual names, the types of sectors we have, which sectors we don't want to have is very important. So if there's a negative outlook on, say, oil, and you want to have no oil or a reduced amount of oil in the portfolio, but you want to make sure you're still exposed to banking, technology, consumer staples, materials, and all the other sectors out there that's available to you. Cash is a big component in there when you want to increase cash, when you want to decrease cash. Of course, real property is also important, whether that be real estate investments or even gold, especially these days. Of course, we've seen a rise in gold as the fear of inflation starts to increase, and it's an important position to have in the portfolio as well. So when you're building a portfolio, what other aspects you look at other than different sectors? Of course, there's geographic risk. And a lot of people will automatically just invest in different countries. But always keep in mind as well, every time you go outside of Canada, if you're going to be spending your dollars inside of Canada, your domestic currency, or if you live somewhere else, your domestic currency, every time you invest outside of that, you're taking a currency risk as well. We've seen that work in your favor or against you. So you could have a very good investment in a foreign currency, but if the currency itself goes sideways, that 10% return you had, when you bring it back to Canadian dollars, you might lose it on the exchange rate. So be very cautious about that. You can buy a lot of investments hedged, so tagged or marked to your local currency, especially if you're using things like ETFs or mutual funds. But really take into account your currency risk that you have in the portfolio, especially on fixed income. Those interest payments you're receiving might look a lot more attractive than the Canadian interest rates, but keep in mind every month or every year, whatever pay date it is, every 6 months, you're going to have to exchange that back to Canadian dollars, or if you're not going to change it back, have it in a currency account that will maintain it in its currency, and then you can control the date on the exchange. So be very careful of foreign investments. And we also want to look at how different investments perform against each other. So that correlation number, we've talked about correlation in previous videos, but correlation, so that's, do they track together? Are the industries intertwined? So for example, if you bought a pipeline and an oil company, of course, they're going to be very closely intertwined. Or even if you're buying a one tech company versus another. They might be very correlated as far as the type of business or what type of economy they perform well in. A contrast in type or sectors would be like utilities, your power companies, versus something growth oriented like tech. They're generally not very closely correlated. If we're in a very high growth market, of course the tech's doing better, and your utility probably won't be doing poorly because it pays a good strong dividend, but it's probably not performing as well. But then if you go into a tough recessionary market, of course your more stable dividend paying utility company is going to do better than a growth story might do, especially if people have less discretionary income to spend into technology. So you have to look at the correlation between each position. You want a certain amount of negative correlation across the portfolio. Some sectors are inevitable. Well, you want to calculate that out through the whole portfolio to make sure that how much risk you have in there, or how much correlation risk you have in there. And then finally, you want to make sure that that whole package matches your risk. I've talked a little bit about growth stocks, the more conservative positions, fixed income. That mix together has to have those historical dips that are going to be in line with the amount of risk that you're willing to take in the portfolio. Really easy to put a portfolio together and look at it historically and say, what's the worst case scenario this has been through, what type of economies it's been through, and how it performed in those types of economies, for example, a recession or a growth phase, and how it's moved up and down through those periods. So really important to look at that when you're building a portfolio, because otherwise you could think you have a very diverse conservative portfolio, and it positively correlates, and all of a sudden you take a big hit with the market. And we've seen that actually in a lot of mutual funds. We talk about this in one of our other videos, where we've seen balance funds, buyers go in thinking, hey, I've got a 50-50 split between fixed income and equities. I'm going to be better protected in the downside. But in reality, when we get into really stressed economies, those two assets positively correlate more and more as we move along here. Back in the 70s and 80s, they were very, not fully negatively correlated, but they tend to be more negatively correlated than they are today. And that's just the markets being more efficient, information flows faster, and cash moves faster. Technology has transformed how the market works, and you have to make sure that you take that into account when you're building your portfolio. So that's all I'm going to talk about today. Of course, as always, if you have any questions, reach out to us. You can find our contact information down below. Please subscribe to these videos if you want to hear more of what we do. Go to mikeonmoney.com, where you can reach out with us. You can book an appointment directly with me, or ask any questions from my team, or even subscribe to our weekly reports. We also do cash management, guaranteed investments that we send out, our guaranteed rate sheet every week, so you can see where all the guaranteed rates are. We have over 40 providers that give us GIC and guaranteed rates, so we pretty much can shop the street for you and give you kind of the top numbers. So reach out to us with any questions. Happy to help in any way that we can, and we look forward to talking to you again soon. Thank you.